Hello everyone, thanks for joining us today and welcome to this presentation of the right way to trade tops and bottoms. Welcome, my name is Stephen Primo, the president and founder of Specialist Trading, and if you are new to our website or not familiar with us, we are first and foremost an educational company. We feel we are your premier site for education in trading virtually all the markets. And I say this because I've been trading for 38 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of them I was a specialist. That's where we get the name Specialist Trading. The specialists were just those gentlemen that made markets in roughly 50 stocks. If you wanted to buy or sell, you had to go to the trader that specialized in. And that's what I did. I specialized in roughly about 50 stocks where I made markets in them, and I traded through the crash. I also traded through the bull market that followed. So I've been in just about every market environment imaginable, and I know what works and I know what doesn't work in terms of consistency. So I left the floor roughly in the mid-90s, the latter part of the 90s, to manage money, to also pursue my own trading account. And 7 years ago, I teamed up with Pro Trader Strategies and formulated Specialist Trading, where all I do is teach and mentor my students the things that I currently use and all the things that I've accumulated, the tips and techniques I've accumulated in my 38 years of trading. I'm happy to say now that through Pro Trader Strategies, my techniques and method are taught and traded in over 92 countries around the globe and virtually every state in the United States. So we have many members from hedge fund traders all the way down to people who are just beginning. So before we begin, I ask that you please take a moment to view our disclaimer. I'm going to show you some great performance results on a particular technique for trading tops and bottoms, something I learned while I was on the floor. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. We're required to show you this, so please take a moment to view it. And as you're doing that, I would also like to take this moment to invite each and every one of you to follow us on Twitter if you haven't done so already. Here is our hashtag, as you can see right there, our handle at SPCLSTTRADG. Every day I post something different, anywhere from daily financial wisdom to current signals that our strategies have generated. And so there's a lot of great free information, although rather limited on Twitter. So Pro Trader Strategies, once again, our sister site, has also set up a Facebook page for us. So you can like us on Facebook and get a lot more detailed information, such as videos and more in-length information in order to learn from us and study from us. So feel free to follow us on Twitter or follow us also on Facebook, like us on Facebook. Now, as I stated in the very beginning of this presentation, we are first and foremost an educational company. It's our opinion at Specialist Trading that the reason why most traders fail is because you're relying too much on faulty information, things that you've been told that were supposed to be consistent or supposed to, work out, and there really is no consistency in them, and if you have used them over time. And I'm saying this from firsthand experience because I was taught probably the same things most traders are taught, techniques, methods that are supposed to be the basic benchmarks of trading. And for the first year or two of my trading, I couldn't make a dime. I struggled tremendously because there was no consistency in these methods. For some reason, we were, told that they're supposed to work, but over time, they really didn't. And so I was lucky enough to get in contact with some mentors of mine. These were also traders on the floor who were able to turn my trading around. So this is what I do with all of my students and members. I teach them the same things that were taught to me, the same edges that were able to turn my trading around. This is what I do with my students. So as you notice here, I purposely put this down. My goal is to teach you, not to force feed you signals, not to force feed you what market to buy, what market to sell, when to get in, when to get out. I just provide you with the information, and then I'm there right alongside with you as your personal mentor so that you can fully understand the process and then go out on your own. There's no reason why you have to rely on an outside source such as myself to tell you what to do and how to trade. After a while with us, most of our students go out on their own to be successful in terms of being consistent. So that's the edge we try to instill in all of our members, and I'm going to give you a little bit of sample of that today. Now today I'm going to give you a great entry technique. It's not a full-fledged strategy. I know at the end of this presentation, a lot of you are going to be saying, well, what, are these all the rules? What are the rest of the rules? I can't do that right now. I'm just giving you the entry technique, but you can build a strategy based off this, or you can add this current technique to your own trading right now, okay? So Let's start out with showing you how most people trade tops and bottoms. And the first thing, actually, I'm going to say before we begin, we have a pretty good crowd here, but many times if we happen to take questions, we seem to slow down the presentation. So I please ask that you have a question. Please wait till the very end, and then we will get to it at the very end of the class. This is going to be not rather lengthy, and probably in about 20-25 minutes we'll go to the question and answer period. So once again, if you have any questions, kindly wait till the end. The only question I will answer is the most popular one, and is this being recorded? Yes, it is. We record all of our webinars. So if you have to leave early or if you're having technical difficulties, you can always request a link to this recording from Pro Trader Strategies, okay? All right, so we'll have the question and answers at the end. Now let's start out with the way most people trade tops and bottoms. And once again, I'm saying this from experience because this is the way I used to trade, and this is the most basic way that people trade tops and bottoms. Let's start out with stocks for all you stock traders there. Now we're going to start out with looking at some older charts just for educational purposes, but then I'll show you some examples as recent as today. Here's an older chart of Cat Tractor, and as we can see here, if you're trading tops and bottoms, the standard conventional wisdom always tells you to use some type of a tool. It can either be an indicator or something you've devised, or just something that tells you when markets are overbought or oversold. That's how we're going to be able to figure out when we have a top or a bottom in place. Now, I'm looking at the stock Caterpillar tractor here, and on the very bottom, all I've done is simply plot a slow stochastic tool, an indicator. I haven't edited it, I haven't changed it. In fact, I don't even know the basic parameters of the tool. All I know is that the upper benchmark should be 80 here, and the lower benchmark should be 20. So conventional wisdom tells us that when these indicators go above and then cross over, that's your signal to sell, because obviously the market is overbought. And conversely, when they get down below the lower threshold and cross over, well, that's your signal entry point to cover and then go long, because obviously the market is oversold. This is very basic, but a very standard way in which people trade overbought, oversold. And remember, you can use this with virtually any overbought, oversold tool. I don't want you to think that it has to be the slow stochastic. It can virtually be anything that tells you markets are overbought, oversold. It could be something that you've devised. It could be someone on TV telling you that the market is overbought or oversold. And so this is what usually happens. This is the way I used to trade. You'll look for something in the so-called oversold area, and when the lines cross, well, that's your buy setup, and you buy here, and it works pretty well, right? Look at the Cat Tractor. It went all the way up, roughly about 5 or 7 points. And then when the indicator gets in the so-called overbought territory and the indicators cross, well, you exit. And if you're more aggressive, you would go short. And lo and behold, the market changes and starts to go lower. All right, so now you're short, and the tool goes down into the oversold area now. The lines cross. This is your sign to cover, and now you go long. So you've just had 3 great trades. You feel great about this technique. You think this is fantastic. It couldn't get any easier than this. So now you've covered your short, you're long once again, but this time it doesn't go up. In fact, it goes much, much lower. But that's okay. You've already had a couple of great trades under your belt, so you decide to do what we call averaging down or doubling up. After all, you won't need it to go up that much higher just to break even. So you buy some more, and it goes up a little bit, but never gets into the overbought area, and it goes even lower. So now you continue to buy and buy until ultimately you've given everything back. Okay, look familiar to anybody? Now this is just not in stocks. We can also apply this to the E-mini S&P. All right, let's look at a different time frame with a totally different market here. We're looking at an older chart of the E-mini futures. This is a 5-minute chart. Same slow stochastic as plotted, same parameters. All right, we're using the same method. We get into the so-called overbought area. The lines cross, so we sell, right? And all of a sudden, the E-mini drops about 5 or 7 points. Looks pretty good. It gets now into the indicator, I should say, gets now into the so-called oversold area. So now we decide to cover our short and buy. And we buy right at the bottom of that sell-off, and it goes right back up again. So now we're in the so-called overbought area. So let's keep going. Let's sell, and now let's decide to go short. So now you go short, but it doesn't go down this time, and it keeps going higher and higher, and all the time you're selling more and more, hoping it's going to crack, but it never does, okay? So you had a couple of really good trades, but by the end of the day, you've given everything back. Once again, this is just not privy to stocks and futures. You can also see this in the Forex markets. In fact, you may even see this more in the Forex markets because of how strongly they trend. Here's a chart, an older chart of the Swiss franc. Same slow stochastic plotted on the bottom. It's obviously in the so-called overbought territory. So what do? Conventional wisdom tells you to sell. So you sell, and let's say you have the aid of somebody in some chat room saying this is at some tremendously strong resistance. Let's say it's at some Fibonacci level, or even better than that. Let's say that some trading guru follows the institutions and says, watching their volume, this is where it should hold. All right, so you sell, you feel pretty good about this, and it doesn't go into the oversold area. In fact, it keeps going higher and higher and higher. So unlike the other setups, you didn't even have a winning trade. You had continuous losing trades, and you never made any money. In fact, you probably blew out your account trying to short the Swiss franc. Do these scenarios look familiar to anyone? I know they look familiar to me because this is exactly the way I used to trade my first year or two on the floor. See, I would have 2 or 3 great trades, and I thought I had it all figured out. I was following all the rules, all the conventional wisdom, until the next trade where I'd get everything back, and then I'd try to make it back and then lose more, and then finally at the end of the month I was in the hole, and I had started out so strongly and gave everything back. This is the way most traders trade. In fact, I would venture to say this is why 80% of most traders fail, is because we're following faulty conventional wisdom, things that are supposed to work, but really after time show no real consistency in them. Now, don't get me wrong. I know there probably are some traders who are probably very skilled and able to make money trading tops and bottoms. But out of the majority of us, in fact, out of the totality of traders, they're probably only 1 or 2%. And myself not included. I've never been able to trade picking tops and bottoms. So my mentors, some 30 years ago, saw how much I was struggling. And they took me aside and they said, Steve, listen, if you want to be a consistent trader, you have to get this mindset grasped, first of all, in order to trade tops and bottoms. And I said, what is it? And they said, there is simply no such thing as overbought or oversold. Okay, I'm going to repeat that again just to stress how strongly a concept this is. There is no such thing as overbought and oversold. And when they first told me this, I couldn't believe it. I thought, no, this goes against everything I've been trained, everything I've been taught. You know, something gets overbought, you sell it. Something is oversold, you buy it. But they explained to me, they said, Steve, think of a market, any market, think of a stock, think of a future, a currency pair. It can go up as high as it wants. We've seen markets be overbought for weeks, if not years. And it's the same thing with something being oversold. We've seen markets go straight down and continue to go down lower and lower and lower. And some stocks have, does anyone remember Enron? It's gone bankrupt. It goes down to zero. So there is no such thing as overbought or oversold. Sure, it'll work every once in a while, but it's similar to going to Vegas and trading the slot machines. You know, every once in a while you'll have a winner on the slot machines, and it gives you this false sense of security with all the lights and whistles going off and all the money clinging down there in the tray. You think you're doing okay, but over time you really see that you have nothing to show for it. It's the same way with conventional wisdom of trading overbought or oversold. Every once in a while, you'll get a winner trading this way, but over time, you really have nothing to show for it. Take it for someone who's been there, okay? So I asked my mentors, I said, okay, it took me a while to really grasp this concept. But once I finally gave in and agreed there is no such thing as overbought or oversold, I said, what is the correct way then to trade tops and bottoms? And they said, Steve, the right way to trade tops and bottoms is simply to go with them. So I said, what does that mean, go with them? So this is the technique I'm going to share with you today. It's an entry technique of going with tops and bottoms. Once again, it's not a full-fledged strategy or a full-fledged system if you're looking for that. It's simply a piece of the puzzle. But you can add this onto any strategy you currently have, and I really think it'll increase your odds for success. You can also build a strategy based off what I'm going to share with you right now, okay? So let's go into this. And once again, if you have any questions, just kindly wait till the very end of the presentation. Let's go back and look at that older chart of Cat Tractor. Remember, we had a couple of good trades at the beginning. but then we gave everything back trying to buy as it kept going lower and lower and lower. Okay? Here's the thing my mentors taught me. They said, whatever strategy you're trading, whatever market you're trading, you must have one thing always plotted on your chart. I don't care if it's a 5-minute chart, a daily chart, a monthly chart, but you should always have it plotted. And what is that? It's the 50-period moving average, okay? And what's the purpose of this? Well, the purpose of this is we ask ourselves a question before we pull the trigger. We ask ourselves, where is price in relation to this 50-period simple moving average, all right? If price is above, well, then we're only going to be buyers. That means we'll only look for buy setups. But if price is below the way it is in this scenario, what does that tell us? It tells us that we're only going to be sellers. We are in no way going to be looking to buy anything. All right, and this is where most traders have trouble because they're on the wrong side of the market. You're trying to buy when you should be selling and vice versa. So here's the first thing: you always have to plot a 50-period moving average regardless of time frame, regardless of market, and ask yourself, you may want to write this down, always ask yourself, where is price in relation to the 50-period moving average? I don't care what some guru tells you on TV or someone in the chat room. If price is above, you shouldn't be selling anything. And if price is below, you should not be buying anything. Because over time, you will not get that consistency, which is what we're looking for. All right, so price is below. So what does this tell us? This tells us that we're only going to be selling Caterpillar tractors. So in other words, we're not in any way going to be trying to pick a bottom, because we're only going to be looking to sell. So if we're looking to sell, we go back down to our indicator here. And once again, right now we're looking at the slow stochastic, but it could virtually be any tool that tells you you're overbought, oversold. So what you want to do is identify all of these so-called oversold areas right here, circled in red, okay? That's where conventional wisdom tells us that we should be stopping, all right? So if we've located all of these so-called oversold areas, then we want to go back to the chart and identify all of the short-term bottoms that were created, but only the ones that were created while we were in the so-called oversold area, okay? Why? Because we want to exploit them. In other words, since we have grasped the concept that there's no such thing as overbought, oversold, we're going to exploit it, because this is the way most people are holding on to that belief that things will hold at oversold. And we've seen that they don't. So we're going to exploit it. So once we trade 1 or 2 ticks below those benchmarks, that's our sell signal. And now, as before, where we had a couple of winners, but then we gave everything back with a series of losses, now we have nothing but a series of winners, because we're in sync with the market by using the 50-period moving average, and we're exploiting so-called oversold areas. Okay, see how simple that is? Let's look at the next example we shared with you earlier. That's the E-mini one. Now we're going to a 5-minute time frame, an entirely different market. What's the first thing we do? We add a 50-period moving average. Now we ask ourselves, where is price in relation to that 50-period moving average? Price is above. Okay, so right off the bat, we've eliminated what we feel will be half of your losers. We're only going to be buyers. We're not going to sell. If price is above, we have no business at all looking for sell opportunities. It doesn't matter. We're never going to sell anything. I don't care if you use one of my strategies, one of yours, something from another educator. You should always buy only if you were above the 50-period moving average. Okay, so since we're buyers, well, what are we going to do? We're going to exploit so-called overbought areas, because we know there's no such thing as overbought. Prices will go up as high as they want to. So here are the so-called overbought scenarios using this particular tool. All right, every time we were above the threshold of 80. And now we just want to identify all of the tops that were created while the oscillator was above that overbought threshold. Okay. And all we have to do now is simply buy once we trade 1 or 2 ticks above them. So now when we had maybe 1 or 2 profitable trades in the E-mini and then gave everything back, now we have once again nothing but winners. Now I know the first thing you're probably saying is, well, Steve, where do I place my stop? Where do I get out? You know, what about money management? Remember, I'm only sharing the entry technique. The other things will come later on in another webinar or once you become a student of mine. How about the Swiss franc? Okay, this particular scenario, the last time we traded, trading at conventional wisdom, we didn't make any money. Every trade was a loser. Why? Because we were trying to sell as it kept going up. What if we had plotted the 50-period moving average beforehand? Guess what? We were above the 50 the entire time. Do you see how this simple tool will keep you out of trouble a lot? Because you're above the 50, you never want to sell anything. It's that easy. So if we're not going to be sellers of the Swiss franc, what are we going to be? We're going to be buyers. If we're going to be buyers, we want to locate all the so-called overbought scenarios right here when the indicator was above its overbought threshold, when the indicator was telling us we're in overbought territory. And then we just identify all the tops that were created while we were in the so-called overbought conditions. And then once we trade above, that's your buy signal. So before, we had nothing but losing trades where we probably blew out our entire account. Now we have nothing but winning trades. So you don't have to hide your account statements from your significant other. You can show her what a smart trader you are, or he, what a smart trader you are, by simply saying, boy, I'm in sync with the trend, and I'm not caving into conventional wisdom, because there is no consistency in trading with these conventional methods that we've been taught. All right, so that is the technique in a nutshell. You should understand it now. Let's go through a number of other examples just so you can understand and see what it looks like in some more recent trades. Let's look at some more examples, and let's start out with stocks once again for all you stock traders. Now, we haven't had a lot of buying scenarios because the market only until recently has been pretty much headed straight down since August. But here's an older chart of HAS going from March all the way up to July and August. First thing we ask ourselves, where is price? Obviously, price is above the 50-period moving average. So don't you see the strength you would have had in knowing that you wouldn't have even tried to short HAS? The only thing we want to do is buy it. So if we're going to be buyers, then we're going to exploit all of the so-called overbought conditions, circled in green here. So we located all of them, and then we just simply identify the tops that were made while we were in the so-called overbought conditions. And then once we trade 1 or 2 ticks above, well, that's your buy, okay? And that's it. Now, we usually tell our students using this particular entry technique to take the first signal, because the first signal usually gives you the best bang for your buck. In other words, you have the highest rate of profitability only because you're at the beginning of a nice run if this continues to go. So had you taken this very first buy signal here, roughly around 65, well, that would have been 20 points to the upside roughly in the next 3 or 4 months, okay? All the time you're long, you wouldn't have to worry about news, you wouldn't have to worry about earnings, you didn't have to worry about what's going on in the world. We're just simply on the right side of the market. How about Yahoo? Here's a more current chart coming into the first week of October, all right? Would it have been wise to try and buy Yahoo here in June and July? No. Sure, there were a couple of quick bounces, but you would have had to been very quick and then gotten out very quickly, okay? And right here as well. But if you're trying to really be in for the longer trend where you make most of the money, the smart thing is to be in sync with the 50-period moving average. So where's price in relation? Price is below, so we're only going to be sellers. If we're only going to be sellers, we're going to exploit so-called oversold conditions, because we know there's no such thing as oversold, all right? According to this indicator, we were oversold all the way back in June and July, and we kept going lower and lower. So once we've located the oversold conditions, then we identify the bottoms that were created in the oversold conditions, and we simply sell, if you're so inclined, to go short 1 or 2 ticks once it trades below. Now, had you taken that very first setup, well, that's 12 points you could have made in the next 3 months or so to the downside. How about TJX? As we can see here, once again, we are above the 50-period moving average. We want to exploit the so-called overbought conditions. Once we've located them, we simply identify the tops. We have a lot of tops here that were created. And if you had taken the very first setup, well, that's 10 points in the next couple of months, okay? And then lastly, let's look at when. We were kind of oscillating above and below the 50-period moving average. A lot of people could say, well, Steve, how do I know what to do here when we're above and below? Well, for an extra added clue, just go down and look at the tool you're using. Even if we were above the 50, did it give you a chance to go long? No, because we were never trading in the so-called overbought territory. The whole time we were either in neutral territory or below or in the so-called oversold conditions. So you know that the only thing you can do is to sell using this indicator. So we're going to exploit those oversold conditions. We find the bottoms that were created, and had you taken the very first setup right here, well, in the next 3 months, coming into the first week of October, which was just this past week, that's 45 points to the downside. Now, you tell me, would you have rather been short WYNN, win, or long this past 2 or 3 months? All right? It's so much easier when you're in sync with the trend. Now, we realize this is expensive stock, and not everyone likes to short stocks or has the account size big enough to do that. You can apply this technique with options. Instead of entering and purchasing or selling the stock, you can simply once you get an entry set up, you can simply purchase long calls or long puts. Now, this just doesn't stop with stocks. Let's look at crude oil. All right, we can go into commodities now. This is a weekly chart of crude oil. A lot of people are always wondering, boy, what's oil doing? We don't really care. As long as oil is below the 50-period moving average, that's your signal. You shouldn't be buying crude oil. It's probably going lower. Until you get consistent closes above the 50-period, crude oil is going to continue to go lower. So here's a chart, a weekly chart coming into the first week of October. As we can see here, we have all these oversold conditions. Look how long on a weekly time frame we were oversold. Do you see what I mean? Whereas there's no such thing as oversold. Had you try and pick a bottom somewhere here, you would have lost a lot of money. So don't you see how it's easier to swim with the current at your back as opposed to trying to swim upstream? There's no consistency when you're trying to swim upstream. So if price is below the 50 on this weekly chart, we're going to be sellers of crude oil. We're going to exploit the so-called oversold areas, locate the bottoms that were created, and you could have sold. If you had taken the very first setup, that's 45 basis points to the downside in this last year, just shorting crude oil. Not worrying about what's going on in the world. Remember, we don't want to follow conventional wisdom where we have to follow news reports. We have to follow what's going on globally. That's great. You need to know that information if you're an investor, if you're holding things for 5 to 10 years. But if you're trading, there's really no consistency in following news or earnings reports because pretty much everything is in the price. I stopped looking at news over 30 years ago, and I was on the floor and I wasn't even looking at news. You can even apply this to sugar. Okay, now here's a recent setup that just happened this last week. All right, price was oscillating above and below on sugar for all you commodity traders out there. Someone could say, well, I don't know, should I be going long or short? Well, all you have to do is look at the oscillator you're applying. And if you wanted to go short, you need for this to go in the so-called oversold area, remember? So it never got there, so the only opportunities you're given are to go long because we're in overbought conditions. So in the last or mid September, we see here that we made a top. We were above the 50 period, so that's your area for entry. And once we traded above that, well, you would have been long sugar this past week. So it really hasn't gone up that much, but it's something to follow if you're a commodity trader. This is a trade that just happened in the past week. How about the E-mini S&P? All right, let's look at a different market, different time frame. Let's start out with a 60-minute chart. Now, we all remember what happened with the market in August, about a month ago or 2 months ago. It fell out of bed, and a lot of people were saying, boy, there's no way you can make money if you're an intraday trader, a day trader. The way these, hedge funds are running the market and these high-speed computer programs, there's no way you can make any money. That's not true. Don't ever let anyone convince you of that, or don't ever fall into that victim mentality, because it's easier to make money now with all that high speed, because with this volatility comes so many more opportunities. A lot of people in August were saying, boy, the market fell out of bed. You must have really lost a lot of money, you and your students. Not really. Most of our students did great. Why? Because they used that simple 50-period moving average rule. All right. Now, if you're looking at this hourly chart, on the 19th of August, before the market fell out of bed on an hourly chart, the majority of prices were below the 50 period. So we weren't even going to consider buying anything. Now, if you're using this entry technique, well, where was the oscillator? The oscillator had gone below now, so now we were in the so-called oversold area. This was on the 19th of August, before the market fell out of bed. So we knew a day or two to be short on an hourly time frame. Those were our entry points. And had you taken the very first entry point on the 20th, and held it for the next 2 days, and we're not saying you necessarily would have, because that was a tremendous gain, you would have made roughly about 230 points in the E-mini in 2 days, or roughly over, I'd say about, I believe that's 12,000, a little over, or roughly around $12,000 per contract, if you had held it all that time, okay? And you had a number of other opportunities to get in as well. How about a 5-minute time frame? Okay, this is going back to September. Now here we're originally above the 50-period moving average, and then we kind of oscillated above and below and then crossed below it. So when we were above, we were in the so-called overbought scenario right here. All right, so these were our tops that were created. So this meant that if we traded above them, we would be going long. Well, we never traded above them. So that means we're only looking at the shorting opportunities right here. And here was, the oscillator went below the went below the so-called oversold area, but we were not below the 50. So you can't sell if you're above the 50. You can only sell below the 50. So here was our first indication, then here were two more. Had you taken this very first one, guess what? In a couple of hours, that's 29 points. That's a little over $1,400 per contract, just in a couple of hours. And then let me show you what happened yesterday, okay? Just to tell you that we're not cherry picking. I'm not going to sit here and guarantee you that this technique will work 100% of the time. And you do have to be mindful with money management and how you manage the trades. But I just want to show you how these opportunities present themselves all the time, regardless of market or time frame. Now, yesterday the market opened up very strong and continued stronger. All right, a lot of people, when the market gaps up like that, they say, boy, you know, I shouldn't even trade, because all of the oomph is already out of the market. I'll probably be buying at the top. Well, who knows? Maybe you would have, but if you wanted to use this technique yesterday on a 5-minute chart, obviously we're above the 50-period moving average, okay? This is yesterday on a 5-minute time frame. We were obviously above that. So what does that tell us? It tells us the entire day we were just buyers. We weren't even going to consider shorting the market. Had we tried to short the market, we would have lost a lot of money. But we were on the right side the entire day on this 5-minute time frame. So we just simply identify all of the overbought conditions. That's what conventional wisdom tells us. This whole time it was telling us, well, you're overbought here, it should be going lower, but it didn't. Well, you're overbought here and here and here and here, it continued to go higher. Remember what my mentors taught me? There is no such thing as overbought or oversold. If a market wants to go as high as it will go as high as it wants. So we're just going to exploit that. Here are all the tops that were created. And had we taken the very first setup right here, for roughly in the first hour of trading, well, that's almost 13 points, 12.5 points. Or if we just held to the end of the day, that's roughly $600 per contract. We had 10 contracts, that's $6,000 in one day. All right, let's move on to the Forex markets now, a different market. Going back to a daily time frame, here's the Canadian dollar coming into October. We are above the 50-period moving average, roughly starting in July. So from that point on, we're only looking to be buyers. That means we just want to locate overbought conditions. Once we have found these three areas, we simply identify the tops. And once we trade above, that's our entry to go long. Now, this is on a daily chart. Back in July, had we taken that very first setup, that's 700 pips, holding for the next couple of months. That's $7,000 per contract, just trading the Canadian dollar. Now, if we can go to a different time frame, here's the Australian dollar on a weekly time frame coming into October once again. Right back in September, just about a year ago, September 2014, as you see way up here, we crossed below the 50-period moving average, and we had 2 or 3 consecutive closes, 2 or 3 consecutive weeks. So right here, we knew that we are not going to be buyers anymore. We've had 2 or 3 closes below. So from now on, we're just going to be sellers. So all you had to do was locate, and look how long on a weekly basis the Australian dollar has been oversold. Almost a year, okay? So I thought oversold meant it's too much, it's too much selling going on. It's supposed to bounce. Does it look like the Australian dollar has bounced? Not really. So why not just go with it? There are the bottoms that were created, the short-term bottoms that were created while we were in the oversold area, and had you taken that very first one and held it up until now, you have roughly about a $17,000 gain by trading just one contract, okay? Because you have 1,700 pips. So it just shows you the strength and the power of this entry technique, and plus using these edges here, which I just shared with you. Now, 2 points to remember before we go into the question and answer portion, because I'm sure you have lots of questions, but two extremely important points to remember. Remember, this is what my mentors taught me. It took me a little while to grasp. I really didn't want to, but finally when I gave in, that's when my trading started to become consistent. And that first one was there is no such thing as overbought, oversold. I know we're all trained to think that something has gone up too high. It's never been this high before. We always hear, well, it's hitting resistance. Oh, the institutions are selling it. Here's where the Fibonacci resistance is. You know, there's always a number of reasons why. But we've seen markets continue to go through them. And so then everyone recalculates and says, oh, okay, well, this is now the new scenario. It's the same thing with going lower. You know, we've always been told markets are way too low. They've never been this low before. They're hitting some Fibonacci support. All the institutions are buying here. This is the buy zone. We've all heard that, and sometimes they do stop, just like sometimes a slot machine will give you a winner. But over time, there really is no consistency. Therefore, there is no such thing as overbought, oversold. There's just short periods where every once in a while they will stop. So if there's no such thing as overbought, oversold, if you really are grasping that concept, then you should never ever try to pick tops and bottoms because you will have no consistency. All right? So, as we conclude here, I want you to ask yourself honestly, do you think any of these edges could have helped your trading this past year? I know some of you may be saying, well, Steve, this is all well and good, but it's just not my style. I don't personally trade this way, and I really, have been taught, and I really want to hold on to my beliefs. Okay, I'm not here to convince anyone that any other educator is wrong or that what you're doing is wrong. I'm just trying to show you what has stood the test of time and that I've been using for nearly 40 years now that has been able to help my trading. But what if you could just apply one of these edges that I share with you today? You don't have to change anything. You can still trade the way you want, but just apply one thing, such as the 50-period moving average. Let's look at this older example once again, the TE. It's really only a couple of months old, but someone looking at this would say, well, Steve, there's no real trend here. We're just basically going sideways, as the arrow shows. And I was always taught, I'm sorry, but this is the way my mentors taught me. If it's market's in a range, you don't trade it or you don't look for any setups because you're most likely going to get whipsawed. So it's better just to stay away, okay? That's the way I was taught too. But once my mentors taught me the 50-period moving average rule, I asked myself, where is price in relation to that 50-period? Price is above. So this entire time, I would be looking for buy scenarios. And it would be a good thing to do that. That way you wouldn't miss scenarios like this when the stock gapped up. Now, obviously, there was some news that was happening that made the stock gap up tremendously. We weren't aware of any news. No one called us up and told us that the stock was going to gap up. The only thing we were aware of is that price is above the 50-period moving average. A lot of traders will say, well, Steve, yeah, but that's all well and good, but I'm already in a position. Like, what if you're already in a position and the news comes out, such as this with El Pollo Loco back in August, okay? You can't do anything. It's too late. Sometimes the news, will work against your 50-period moving average. That's true. Sometimes it will. I'm not going to say that it works 100% of the time. Nothing does. In nearly 40 years of trading, I have never found anything that works 100% of the time. But the one thing I've learned about the 50-period moving average is that it really has a high level of consistency of really placing you on the right side. So if you were in this stock and you lost because news came out and it gapped lower and went lower, had you used the 50-period moving average, you would have asked yourself, why am I long this stock? You, in fact, would have never been long. Why? Because price is below the 50-period moving average. If price is below, we're not going to be buyers. We're not going to be in a stock that's below its 50-period moving average. In fact, go back and look at your last 10 or 20 trades. I can almost guarantee you that the majority of losers you had were because you were out of sync with this simple rule. Go back and look at them and see, were you buying below the 50-period moving average and selling above? Most likely, if you did, you probably had a losing trade, regardless of market and or time frame. So I think you could have used a simple edge like that. You wouldn't have to trade and change any of your trading techniques. You could still hold on to your beliefs, even if you love to look at overbought and oversold, but you could just apply that, okay? Now, what if I could give you 3, maybe 5, maybe 10 more edges, very similar to what I just shared with you today, but entirely different? Well, this is what we're offering all the attendees today. This is our Secrets of a Stock Exchange Specialist training sessions. What it is a 3-hour video seminar. About 3 years ago, I was asked to speak at a seminar in Denver, Colorado. They videotaped the entire presentation. I spoke for 3 hours. I was the main speaker there, and I gave away a lot more high probability trading edges, similar to the one I just shared with you today. I even went over which indicators to use, which ones not to use. I gave away what I feel is the #1 chart pattern that you should be looking for in virtually any strategy or system that you trade. You should be looking for this #1 chart pattern. But I think the best thing that is on this 3 hours of educational video seminar is that I give all the rules: entry, exit, stop placement, money management, to one of our best pullback strategies, and that's strategy #1. Now, if you're a member of our strategy #1 course, here are some of the signals that were generated recently in the past months and past few days, actually. Last week, BBY generated a buy signal. Now, as you can see, this technique, this strategy is entirely different from what I just shared with you, because this is a pullback technique. So we're looking to buy on pullbacks or sell-offs within the trend. So the strategy deemed that BBY was in an uptrend, and once it calculated that the uptrend had concluded, a buy setup was generated. And this was on the 29th of September, and this was going into this past week in October. Okay? It can also be to the downside. Now, here's a chart of Volkswagen. Now, if you've been noticing in the news, Volkswagen has had some terrible news lately about submitting faulty reports. The CEO resigned. It's just terrible news. Well, we weren't privy to any of that. In fact, we tell our students, we suggest not to look at news, because it only serves to really cause a lot more doubt and to get you down the road of being inconsistent. Remember, we're trying to be consistent. The only thing we need to do is follow the strategy. And the strategy, before all that news came out, generated 2 sell signals, one on the 10th of August and another one just last month, about a month ago in September. And then look what happened after the second one, okay? Once again, no one told us that the CEO was going to resign or this terrible information was going to be made public. It was all in strategy #1 setup. Now, the same rules can be applied to the currency pairs. Here's one in August, a buy signal in the euro dollar. It looked like the euro dollar was rolling over. I saw a lot of different trading educators saying that the euro dollar was topped out, it was going lower, but strategy #1 generated a buy signal, and look what happened to the currency pair in the next week. And then lastly, for all you intraday traders, it works just as well using the exact same rules. Nothing is altered, nothing has changed. We can look at a 5-minute chart here of the E-mini. I believe this was the last week or so on the 29th. Yeah, we see here on the far right, this is the 29th of September, this chart here. So as you can see here, the strategy deemed that we are in a downtrend. So every once in a while, you have these nice little bounces. These are the pullbacks that strategy #1 looks for. And guess what? Each one of these areas right here was a sell signal generated using strategy #1. So you can see it's a great strategy that is designed to buy pullbacks that have sold off and to sell pullbacks that have bounced in a downtrend. I give you all the rules: entry, exit, stop placement, money management to strategy #1, as well as 3 hours of more video education and trading education in this 3-hour video seminar. Okay, this is not something that is shipped to you. It's a link to a video, an online video, so you can watch it whenever you like. It's not something that disintegrates in 2 weeks. It's yours for life. You can watch it whenever you like, over and over again. There's tons of information jam-packed. In fact, it's so jam-packed with information. My sister site, Pro Trader Strategies, has it marketed on their website for close to $1,000. But we're dropping the price drastically today for all the attendees for taking time out to view this presentation down to $37. You get all of this information plus a full-fledged strategy for $37. And one of the best things is, as well, you are now a student of mine. So you get lifetime correspondence with me. Whenever you'd like to email me a question, you can contact me whenever you'd like. So you get all this tons of information, a full-fledged strategy, lifetime correspondence. All this is usually going for close to $1,000, discounted for the next couple of days down to $37. So I strongly suggest that you take advantage of this short-term offer here. Here's how you do it. You see the link at the very bottom? That is the link that you want, that will take you directly to the sign-up page for $37. So all you have to do is just simply click that, I should say copy and paste that, and that will put it on a browser, and that will take you there. But if you're interested in just clicking on a live link was just posted in your chat box. So all you have to do is just simply click that on, and it will automatically take you to the sign up page. Okay. Now, if you have any trouble, you can contact Pro Trader Strategies. There's their email address as well as a phone number. But I'm going to leave all this information up here so you can just sign up for that $37 deal. But trust me, it's a ton of information. I'm going to be your personal mentor for life. And you can contact me whenever you like, all for only $37. I can almost say that most of you probably spent more than $37 today trading the markets, just with commission costs alone. So you really can't get a better deal than that. So I'm going to leave this up here while I open up the question and answer box. Let me just open this up. Okay, let's see. JH asks, what are the best settings for the stochastic oscillator? Well, first of all I did, JH, was just click on slow stochastic. I didn't alter any of the settings, so I don't even know what the settings are. All I know is that those two lines, those are the upper and lower threshold. The upper threshold, or the overbought threshold, is set at 80. Okay, and the lower one was set at 20. So anything above the upper threshold was deemed overbought. Anything below was deemed oversold. Now remember, I don't want you to get set and think that this is a system that it will only work with a slow stochastic and that we have to always apply that. It can be any tool. It can be any overbought, oversold oscillator. Anything that tells you the market is overbought, oversold, something that you've constructed. The only thing is I want you to get straight, is that we're trying to employ the concept that there is no such thing as overbought, oversold. So we're going to exploit a tool that tells us something is overbought, oversold, and just like I said, just simply exploit it. Okay. If you're having trouble signing on, I believe there are a couple of links posted. I see some people are saying that they're having trouble signing on. There are a couple of links posted on the website, or I should say on the chat box there. You can try both of them. I think someone said the second link works better. Or you can just email or call up Pro Trader Strategies. They should be able to set it up with you really easy, okay? But other people are saying that the first time it didn't work and then it's working fine the second time. So continue trying. But don't worry. I mean, if you let us know, call us up tomorrow that you had trouble, they'll still honor that. But remember, this is only going to last for a couple of days, okay? Ben is asking, are the 50-period moving average just the 50 days moving average on a daily chart? That's a good question, Ben. All it is whatever time frame you're looking at. So in other words, it's basically called the 50-day moving average. What I like to do is call it the 50-period moving average, because it takes 50 of the last time period you're looking at, okay? In other words, if you're looking at 5-minute charts, it takes a look at the last 50 5-minute bars. If you're looking at daily bars, it takes a look at the last 50 daily bars. If you're looking at weekly bars, it takes a look at the last 50 weekly bars and those closing prices, and then it comes up with a moving average of them, okay? So if you're looking at a 5-minute chart, do not plot a 50-period daily chart. Plot a 50-period chart based off of 5 minutes, okay? If you're having trouble with that, you should contact your tech support of whatever charting software you use. But it should be very simple. Remember, the 50-period moving average is based off of the time frame you're trading, not based off of a higher time frame or just based off of only dailies. All right. Now, if you're looking at daily bars, yes, you should have a 50-period moving average of daily bars. But not everyone looks at daily bars. Okay. I hope that answers your question. Remember, once again, if you're having trouble clicking on that link, it should be on the chat box. Just simply click that on. It should take you there. Or if it isn't working for you, most people are saying it is working now. But if it isn't, just simply email or call. Probably better if you call directly. They can take your credit card for $37 over the phone at Pro Trader Strategies. They have a great tech support system there. They can help you with anything, and they'll have you up and running right away. Please remember, though, that there's nothing that has to be shipped to you, so I don't want you to think you're going to be getting a disc and you have to wait, or you have to make sure that it works properly in your computer. This is simply a link that's sent to you this afternoon, and you can be watching the video this afternoon, and you can be studying and getting the strategy that I just shared with you for the pullbacks, okay? Any other questions while you still have me? Other than that, you have this great entry technique that you can start applying as soon as tomorrow if you'd like. But please, if you're going to use the entry technique I shared with you, please paper trade for a while so that you fully understand it, all right? It's not just enough to think you have it down and then start to use it, and because I can almost guarantee you, you'll probably lose money, okay? But so practice it by paper trading for a while until you really fully understand it, and then feel free to use it whatever way you'd like, okay? Now, remember, we're going to be closing in just about a couple of minutes from now, but I just wanted you to remember, if you are trying to sign up and you're having difficulty, you see that some of the people are having difficulty, other people are getting through all right. If you're having difficulty, though, just kindly call Pro Trader Strategies, okay? The number right there, and they'll take your card over the phone. A lot of people would rather do that anyway, and they'll have you up and running with a $37 deal. But you don't want to miss that, because I said that's only going to be for a couple of days, then it goes back to nearly $1,000, okay? All right, so it looks like we're ready to close. I want to thank you so much for attending today. Remember, go back and look at your last 50 trades. If you had applied that 50 period moving average, I really think that you would have done much better using that simple tool. If you want to get more information, more things that are just as consistent that can help your trading, regardless of what style or what markets you trade, take advantage of that $37 deal. I don't think you'll find anything that cheap, okay, with so much jam-packed information available. I want to thank you so much for attending today. I want to thank you so much for viewing this presentation, and I look forward to all of you becoming students and members of mine at Specialist Trading. Thank you so much. I shall see you next time. Bye-bye.